Rahul Chadha joins us, founder and CIO with Shikar Investment Managers. He joins us with a big view on what is the mood like on Wall Street, what does the Trump victory mean for India, and is the strength in the dollar in dollar and the dollar index is real. Rahul, good morning. Thank you for joining us. 2016, when Trump came to power, markets were nervous. 2024, when Trump has come back to power, markets are excited. Why a different reaction to the same person?
I think the reason for that is, look, market are excited about the boost to growth locally here in the US. There is this whole buzz that, look, these guys have kind of put together close to 300 regulations which can be done away with, cut down on the bureaucracy which came over last kind of a couple of years in the US, boost the domestic energy, particularly the shale oil production, which is going to be a big competitive edge for US manufacturing, etc. So that's positive, but I think there are a lot of uncertainties here. The uncertainties is, look, if you've got a blanket tariff coming of 10-15%, what does it do to US inflation? Again, with what Trump had initially talked about, the whole tax cuts and everything, that increase the deficits significantly higher. So what does that mean to again the 10-year yields, or does it spook the bond markets? And I think that is what the market is kind of grappling with, and that's where we've seen euphoria today, where you've got the Russell 2000 or the US mid small cap doing exceedingly well, US banks doing well. But from here on is going to be more of a breather, and trying to get more clarity on the policy.
So, what is the trade like? I mean, there was for next couple of years, what becomes a easy go-to Trump trade? You know, I'm bringing this point out, and I'll supplement with a thought here for the benefit of our viewers. 2020, there was something called a Modi trade, which is that you bought into defense, railways, infra. That turned out to be like a pot of gold. So, what becomes now the Trump trade for the world?
Okay. So anything which helps in US manufacturing and has a presence in the US would be kind of a Trump trade. So you can think of it as any of the power tool companies which are present in the US. You can talk about it, let's say some of these, what we have in our portfolio, something like a Hyundai Electric, which has transformers capacity in the US and can supply to the local market. So any industrial which is not really subject to huge amount of tariffs is present in the US is positive. I think this is also going to be positive for the Indian software services company. Is going to be also positive for the pharmaceutical exports from India. Look, Trump's talked about putting tariffs on imports into the US, but our sense is I think the numbers are going to get fine tuned, and anything and everything where US has a manufacturing edge or a large local manufacturing capacity is going to be subject to tariff. Outside that is going to be more of this gentle nudge on asking corporates to put capacities in the US. But from an India perspective, I think the software services companies should benefit. Already, what we're seeing is over last 6 months, the top 100 companies globally looking to embrace AI meaningfully. And I think the next step after they've got the chips is going to be how do you engage these companies from the customization, from the data analytics perspective.
Rahul, we were just pointing out as to how the currency markets have been moving, and you've got the rupee currently at a record low. A stronger dollar, you think, would continue to mean that FIIs sell emerging markets, and within that, India, which in any case they've been selling quite hard all through October too.
Okay. So I think stronger dollar definitely for first 3 to 6 months, as the focus comes back on US growth accelerating, as the focus comes back on US productivity increase, etc. Through what we talked about, all these cut in regulations. I think medium term one needs to get better clarity on this, because if the tax cuts are going to be so much, if incentives are going to be so much, does the boost in growth kind of compensates for the fall in tax revenues? If it doesn't happen, then obviously, again, this whole thingy of dollar debasement, huge US deficits, and not enough bias for that comes to the forefront. So definitely a stronger dollar for 3 months, but beyond that, we need kind of a more evidence of fiscal prudence, and that's where it's very important to see what is the Treasury Secretary like, and how much of the electoral promises or the rhetoric is actually followed up with.
Rahul, morning. Wanted to also understand your take as to how you see the liquidity situation shaping up, given that there has been quite a relentless FII selling for the Indian markets in particular, with now all of the news having been baked in. What is the outlook on the FII situation?
Yeah. So to that point, look, post the elections in June, we were kind of um, uh, I would say not very constructive for India from a short-term perspective, and we were reducing our exposure. And in fact, about a month back, we were running one of the largest underweights we've run in India for last 10 years, 4-5% underweight vis-a-vis the benchmark. I think post this correction, post the local euphoria somewhere abating, we are increasingly getting more positive on the market. See, India is a structurally very strong story. It's going through a cyclical downturn. So the question here is when to add to the Indian exposure in the coming months. And I think that's the debate which is there internally in the team, that when do you take some money off China, which obviously has done well and has a good kind of a tailwind on the government stimulus. But I'm not sure whether that stimulus would be to the extent which is required, which is to the extent of 7 to 10%. I think the sense we get is the stimulus which is going to come over next 3-6 months is going to be 3 to 5%, where it may fall short of expectations. So then automatically, look, as we see better valuations, as we see time correction in India, the market becomes very attractive. Large caps haven't done well. So increasingly, if you ask me today, one would be willing to put some money to work in large cap financials. Reliance looks interesting. Exporters, tech, again, the pharmaceutical names look interesting here. Mid caps need some more pullback, some more correction. And I'm sure with this market sentiment which we have, we'll get that in next 3-4 months.
Uh, with the combination of strong dollar strength and prospects of yields remaining above 4.5%, do you think flows into emerging markets may not come back in a hurry? It could be a long winter.
Nikhil, what is going to happen is a reallocation. And look, what happens here is Fed would move to neutral rates, which is somewhere around 3.5% quickly over the next 12 months. But beyond that, it's going to hold on for a while, which is why the big kind of an expectation of rate cuts for most EMs, which thereby accelerate growth, is not going to be there. You will get some rate cuts over the next 12 months, and post that is going to be limited. So then you're buying structural stories where you don't have any excess or kind of investments, etc., where cycles can pick up. So recovery is going to be slow. It may be kind of a slightly backdated, which is why again from our side, like the way you said, apart from the large caps, I talked about opportunities comes in Indian companies which are gaining share locally, which are also gaining share in exports. So somewhere one needs to build a bit of an export angle in portfolios, companies, whether you can call it in the pharma consumer space, consumable space, in the EMS space, etc., which are gaining share from this China plus one.
Rahul, where does the entire consumption piece lie when it comes to India? Because so far in the second quarter earnings, there seem to be markers indicating that there is a bit of a slowdown, and also, the high base effect, to be honest, which is currently at play. Do you think now the focus is clearly moved from consumption, which was always India's forte? It's now moved to manufacturing, and that's how your portfolio tilt also, needs to be.
So we saw this in 2003 to 2007, where consumption was subdued, and look, manufacturing was much faster growing in the economy. And look, from a market perspective, market trades the relative growth within sectors, and wherever the growth is higher, that's where the money moves, and that's where the valuations get re-rated. I think the same thing plays out. You've got pockets of consumption which are doing very well. You've got travel which is doing well. We've got quick commerce, which is everybody's darling, which has done exceptionally well. And I think these pockets, plus some of these unlisted names, are gaining share from the much established organized players. So one's got to be more nuanced about where one is playing consumption. And that's what we're doing. We like it somewhere in the personal cosmetic space. We like it in the quick commerce space. We're playing through travel, hotels, etc. But outside that, mindful of the names which have worked well for last 10 years, huge market caps, high valuations, because those names may just remain range bound or not do high. And what is also happening is, look, as these names have done well, market caps have become huge. We've seen increased competitive intensity. Take for matter, a jewelry sector, look for, and also take a paint sector. We've seen number of new established entrants kind of come, and somewhere they're also taking share away. They're taking putting pressure on margins for the incumbents, and all that is playing out in the weak or subdued growth for these incumbents in this sector.
There's a lot of pent-up excitement in this entire energy transition theme. But Donald Trump has gone on record and said that he would shut down a lot of clean energy projects. What does that mean for this entire clean energy, green energy wave, both locally and globally?
So I think, Anika, that trend continues. So what happens here is as US boosts is local oil, shale oil productions, etc. Obviously, and US can produce it much, much cheaper. What our sense is, won't be surprised if oil goes down to $50, $55. And then clean energy has to be kind of an comparable with the fossil fuels or oil at $50 without subsidies. And what we've seen is a big uptake in solar in Europe, particularly with the fall in polysilicon prices, which we saw in China. We saw solar achieve grid parity without any subsidies, etc. So I think those trends are here to stay. US enjoys this captive cheap energy, and again, Trump's been fairly vocal about encouraging it. But the rest of the world is clearly moving towards clean energy, and I think the good thing which happens, particularly from exposure to these companies' perspective, is we saw a significant buildup in your polysilicon capacity in China. We saw significant buildup in the module capacity in China. That capacity increase is kind of slowed down now. So you're not going to get a significant capacity increase. And somewhere around, I think mid of next year, we'll get the bottom for the solar sector, etc. Demand picks up, capacity increase is not happening much, and then you'll see margins and the prospects improve for the sector.
Rahul, so great having you on the show. Thanks as always for taking the time out.
Thanks for having me.
If you like this video, then like, share and subscribe to ET Now.